Hi, good afternoon, everybody. I'm Matt Dimitroshin, the Chief Investment Officer with Composition Wealth. I'm joined by my partner and good friend, Nate Angelo, the CEO of Composition Wealth. Nate, good afternoon. Thanks for joining us.
Yeah, it's great to see you, Matt. It's a
Yeah.
pleasure to be here.
Well, Nate and I want to just kind of catch up. It's been an eventful year thus far already and just talk markets and talk through a lot of questions we're getting from clients. As we go through this, if there's anything you want us to expound upon or address that we haven't covered, feel free to enter it in the chat box and we'll try to get to that. Maybe to kick things off, Nate, just as I said, we've had an interesting first 4 months of the year already. It's been quite an odd dynamic when we've kind of had pretty broadening economy. We've got a war in the middle. We've got tech stocks running again. People excited about AI. A lot of our lives changing, even as we start to embrace AI even more. As I was kind of reflecting back over the weekend, you think about just this decade alone, right? So you go back 2020, we had COVID that came in March of 2020. 2023, you look to April of 2023, and we get Silicon Valley Bank failing, and that caused some upheaval. 2025, tariffs, and we had Liberation Day on April 2nd, and that caused kind of a little bit of some uncertainty and an uprooting of the markets for a brief bit of period last April. And now this year we've got the war in Iran. So I don't know. There's something about March and April this decade where those tend to be a little bit more volatile months. From your experience advising clients over your time, there's all these short-term uncertainties that creep up on us. But what's that right mindset to not lose sight of them, but also keep that long-term picture?
Yeah, great question. I want to pair it with uh, this idea of ITAP. So we've been talking about ITAP. ITAP stands for Iran, tariffs, AI, and private credit. For what we have seen as being the four key drivers of a lot of market movement, call it in, and candidly, sort of drivers of where the economy sits today over the course of these first, 4 or 5 months or 4.5 months into this new year. And bringing this back to that long-term question that you just, gave context for, these are all four things that neither you or I or anyone else can control. And so I think when I think about advising clients and walking alongside on their journey through life, trying to create, the most clear plans we possibly can to make decisions with confidence, there's always the unplanned. There's always the uncontrollables. And we have to make sure that we don't compromise this big picture plan, big picture objective that was laid out during very rational thinking and dialogue. Just because something we don't control happens that then creates emotions in our minds, in our hearts, and in our lives. And it's really important to go revisit that rational conversation you had before the uncontrollables started hitting the headlines of, industry rags, newspapers, CNBC, Bloomberg, etc., and ask yourself a simple question. Is the portfolio I own today still designed to deliver the outcomes that we set out to deliver over the course of, is it 3 years, 5 years, 10 years, 20 years, depending on what your time frame is? And if the answer to that is yes, then you should be doubling down on that investment portfolio. If you answer that question, no, I'm uncomfortable, then there probably is a conversation with your financial advisor to revisit and to say, maybe I'm too heavily allocated to equities. Maybe I'm actually underweight equities because I don't feel like I'm going to have the return potential I need to deliver whatever those outcomes might be. It's not always de-risking. Sometimes it's saying, oh, wow, I should be using this opportunity to increase the weight because I went into this underweighted to equities, whatever that situation might be. But I think the most important thing is to not allow uncontrollables to start to be your driver for decision making when it comes to portfolio allocation and what you own in your portfolio. And the last thing I would say to that, one of the biggest drivers here is AI. And we're going to talk more specifically about AI in a little bit. But when we think about broad themes, you've talked about, several negative things that have happened
Yeah.
over the last decade or so. AI is one of those, potential once or twice in a lifetime situations that has transformative impact to how we do business, how we function, And so we don't want to, only take the negative side of AI if that is somebody's wiring. We really need to be open-minded and objective about what this might mean for us going forward when it comes to our portfolios and ensuring that we're in a diversified portfolio that's going to meet the needs of both not only what we need, but where markets are going as well.
Yep. Makes sense.
So let's shift gears and let's actually talk a little bit about the current environment. If we think about just the last couple of months, there's been a fair amount of volatility. All four of the things that I just mentioned, Iran, tariffs, AI, private credit, all been a part of that at some level. But most recently, Iran's been at the center of everything. And I think we were chatting on Friday, Matt, and we were talking about, hey, are we starting to see some calm? Is this ceasefire actually going to lead, to an answer, in the Gulf? And obviously, it wouldn't be overnight. And we wake up today, and I think the president came out and said something like, the ceasefire is on the rocks. We're not sure if this is actually going to come to pass. And so I guess my question for you is, what do you see based on the current situation in Iran, current oil prices, translating to higher gas prices? I know in the Seattle area where I lived, we hit record highs on Friday. They've come down a couple of cents since then. Uh, where do you see this going, and how do you see the economy's outlook as a result of what we're experiencing in Iran?
Yeah, so as we've kind of talked a little bit in past conversations, the impact, fortunately or unfortunately, is going to be more felt outside the US than in the US. So, US self-sufficient on energy prices. Most of a majority of the, whether it's liquefied natural gas or oil that gets produced in the Middle East, goes to Asia. Some goes to Europe, but a majority of it goes to Asia. So, Asia is going to be the most impacted by the Strait of Hormuz being closed. So thus far, I would say the world economy has weathered it better than most people thought. And a key part of that being is just strategic petroleum reserves have been quite sizable, and those have been allowed to kind of be used as sources of inventory to help meet the needs. We're now getting to a level where we're getting pretty low on actual inventories. And so we'll probably, the globe, meaning we as a globe, will start to feel that a little bit more as we move forward. As it relates to the US economy, the consumer has been robust, and a key driver of the consumer being robust is tax refunds are up 11% year over year. So it just so happened this conflict started about the same time people were getting checks in the mail. And so what did we see in March when all this was going on and oil prices were skyrocketing? Consumer spending went up. And what was really interesting is naturally the biggest area of growth for consumer spending was gasoline because people were paying more at the pumps. The second area that was the biggest area of growth was furniture, something you wouldn't expect. In fact, it was a more expensive discretionary purchase, but people were continuing to spend. And thus far, I think that's what we're seeing. Last Friday, we saw kind of the employment report for the month of April, and it showed that wages were up 3.6% year over year. Tomorrow, we're going to get the consumer price index data. We'll see what the number is, but expectations from economists is it'll show inflation being up 3.7% over the last year. Well, what does that mean? It means inflation is now, if that transpires, inflation will be 0.1% more than what your wage growth is for the average consumer, meaning they're having to dip into their savings to just meet their standard spending needs. I think if people have more money in the bank, if they got a big tax refund, you're willing to kind of spend through that for a month or two. Our concern is if this doesn't get rectified by, I don't know, maybe July, maybe August, I think that's when you start to see consumers going, I can't do it anymore. I can't keep, pulling back my savings or dipping into it. I've got to start to pare back my purchasing power. So I think the risk to the economy is on the come. It's not there yet. Consumers continue to spend. We've just got to kind of see how the politics plays out between now and then.
Yeah, you're definitely starting to see this in some areas that will start to impact consumers. I see the airlines cutting back on
Yeah.
certain routes that, maybe are more local in nature or shorter in nature, and trying to, ensure that they can deliver longer haul flights and or the like. And so I think the consumer is going to be seeing that and feeling that as it pertains to that area. Second, though, something that I think is a byproduct of this and what you were just talking about relative to inflation is I think the other thing people talked a lot about coming into this year was it was a given that we were going to get a rate cut. And that for sure, the housing market or the private real estate market would start to soften, especially, as we think about the middle of the year and going into summer. I was reading this morning, and now, somebody was talking about their view on this, that look, like they don't see in their models, a rate cut on the horizon until, maybe September of 2027. And that's just a guess, candidly, on someone's part. And I'm not here to say that that's the case, but based on what you just stated around inflation, really hard to see rates coming down in the short run anyway. But just thought I would throw that out there for you just for some perspective, because I know that this is something that we read and talk a lot about as a driver of a very important part of our market, which is the real estate market that's been depressed for quite some time now.
Yeah, I would say our models going into the year kind of said by the end of 2026, maybe we'd see two cuts. That's not the case anymore. I would even take your anecdote a step further. If you look at the federal funds futures market, which is just kind of market implied expectations on what the Fed will do, they're not even projecting any cuts to next September. They're projecting a 50% probability of a rate hike by next spring. So kind of flat rates this year and then a rate cut early next year. I found it very interesting. So the last Federal Reserve Open Market Committee meeting, the group that sets the policy at the Fed, there were three members of that FOMC that voted not to keep, they voted to keep rates the same, but to basically hint at they don't see the next a need to cut rates anytime soon. And one of those was a guy named Neil Kashkari, who's the president of the Minneapolis Federal Reserve. And what I like about him is he actually, whenever he votes, votes a certain way that's maybe against consensus, he'll put out a paper on why he voted the way he did. So he actually put out a piece, and he was kind of talking about how he sees an equal likelihood of raising rates as cutting rates, and wanted to kind of make that point known. I personally have the view of, I think those three governors wanted to make the point to the new incoming Fed chair, Kevin Warsh, who's likely to get approved this week, or I think has the opportunity to, that, hey, they're not really supporting cutting rates anytime soon. And so I think that probably leaves, and I think the data thus far says that's not necessary. Goes back to what we talked about earlier, though, on Iran. There's a lot of uncertainty. Just the range of probabilities is so wide. So I think our base case is, yeah, we probably don't see rate cuts the rest of the year, but my conviction in that is a lot less than my conviction in what I had going into the year, and was, wrong on that one. So
Yeah, well said. So let's shift gears to AI. AI has been right alongside Iran in terms of capturing headlines. A lot of really good questions about what is going to be the impact of AI, positive, negative, or somewhere in the middle, and or all of the above, depending on what happens. Now you're starting to hear this talk about AI relative to IPOs. So we have not had the most robust IPO market, call it going back a number of years now. You can throw out an exact number. I won't, but it's been weak, and we've had fits and starts and a few IPOs come to pass. But now we're talking about in my 25-year career, probably three of the biggest, most talked about IPOs in SpaceX, Anthropic, OpenAI, with some of the most well-known and recognized CEOs or business leaders being associated with all three of these firms. And so, the AI spending has been significant. The investing in AI has been significant. The investing in AI has spread not just into individual companies, but now we're talking about ancillary businesses and industries that support AI at the tip of the spear, if you will. So I guess my question to you is, how will these companies I just mentioned, SpaceX, Anthropic, OpenAI, as we think about them going public, how might that actually impact the market dynamics as we see it going forward?
Oh, it's a spot on question. It's going to be fascinating. So if you look at the S&P 500 today, we've talked about the Mag 7 stocks, Apple, Alphabet, Amazon, Microsoft, Tesla, Nvidia, and I'm forgetting one more. But they're in that group, and so there's 7 of the largest 10 names that are in the index. If you looked at the size that SpaceX, Anthropic, OpenAI are expected to go and kind of rumored to go public at, they would all be in the top 10 names of the S&P 500. And I think one of the names that actually is probably going to come out of the Mag 7 is Tesla. It's actually now Broadcom is actually bigger than Tesla. So if you actually put Broadcom in that mix, your top 10 stocks in the S&P 500 are all going to be companies that are heavily tied to artificial intelligence and that theme playing out. And they're going to go from today, the top 10 stocks in the S&P 500 are about 40% of the S&P 500 because the S&P 500 weights the stock by its size of the business. That's 40% is going to go to 50%. So you're into this diverse index of the S&P 500, at least that's what you think, but 50% are all tied to AI. And I think you put it really well, Nate, of in one sense, it can be concerning what's going on with AI. In the other sense, it can be opportunistic. I don't know if that's a good thing or a bad thing to have 50% of your portfolio in AI. And I think part of that reason is I'm not fully convinced all 10 of those stocks end up being AI winners 5 or 10 years from now. I don't know which of them are going to be winners, to be candid with you. And the second piece of that is what's yet to be determined. And you said it, the amount of spending is astronomical. And what is the return on investment going to be? And is that companies going to be as profitable as they are pre-AI? And if they're not, the market might be willing to pay a lower valuation to them. So it doesn't mean they're not successful, but maybe the market goes, I'm not paying 30 times earnings for you. I'm going to pay 20 or 15. And so that can compromise the value. So it's something we're watching. It's going to take time to play out, but it is something I think investors need to be paying attention to.
Yeah, I mean, I think it's fascinating when you look at can they continue to justify the spend that's already taken place, which one would argue they have not yet done.
No.
Number two is there is so much hype behind SpaceX, Anthropic, OpenAI. Can they live up to that? And I think then the question comes in the IPO world of, it's not just about what happens on day one or day three, but what happens on, day 103 and what happens, let alone 3 years down the road, when you've launched your company into such incredibly optimistic views, I think, on the whole, tied to those three names, when you really don't necessarily know a lot beneath the surface as just a public investor. It's hard to get that information. And so maybe you want to just unpack a little bit about the IPO process, your thoughts about, what happens over a 6 to 12 month time frame relative to IPOs, and, maybe draw those corollaries to these companies specifically.
Yeah, and as you kind of mentioned, Nate, there just haven't been a whole lot of IPOs, so it's not as familiar of a process. So when a company goes IPO, if you actually look at the data, Goldman Sachs, to their credit, did some good research on this going back to 2013. The average IPO was up 19% on its first day of trading. Now that's average. I would say there's a very wide range of returns within that average, but that's on average. Within the first week of trading, that average IPO is only up 2%. So it gets to the big pop day one and gives it all back, by the end of the week. And then 6 months later, it's flat. And usually a year afterwards, it's negative. And the reason being is what often happens with an IPO is a company will only sell somewhere between 10 and 30% of their shares to the public. They don't want to throw it all at once because you're probably not going to get as good of a price if you sell it all at once. And they want the market to get to know and understand the company, and then that tends to build a broader base of investors. So what tends to happen is those initial shares get sold, and then they have a 6-month lockup, meaning if you weren't part of that initial, call it 20% that sold, you can't sell your shares for 6 months. You're locked up. And then after 6 months, that lockup expires. And so you get other investors, maybe it could be the insiders of the company starting to sell some shares. And if you have other private equity firms, they might to have 1 or 2 or 3 more further offerings to slowly sell down their shares. And usually what happens is investors get a little wary when you get close to that 6-month mark going, the lockup's about to expire. There's probably going to be more shares hitting the market. I don't need to buy today. I'll wait for that secondary sale and I'll buy it 10 or 20% cheaper than where it's at today. And that tends to be a pretty predictable and reliable approach, but that's with a normal IPO. I've never seen a $1 trillion IPO before. This is going to be a little different. These are great companies, but you put it well, is a lot of nuances on the valuation and the fundamentals. So like my colleague Rusty Haas, who leads our equity effort, he's done some looking at SpaceX. So if you look at a software company today in the public market, it's trading at around, on average, 10 times its revenue. So, if its revenue is $1 million, it's trading for $10 million. SpaceX is trading for where it's rumored to go public north of 100 times revenue. So 100 years worth of revenue. Now, it's growing, and it's growing like a weed. So I don't think using that 100 times revenue is the best way to look at it. But I think the point really being the valuation does imply significant growth to that business, assuming it goes public at kind of the $1.5 to 2 trillion range that's being rumored.
Yeah, and I think what you're trying to draw out there and using revenue, whether it's the right metric or not, is simply it's a multitude of metrics that we need to help people understand for the scale and the magnitude
Yeah,
that will set the expectations of the markets for these firms to deliver, which is something that has never been seen before.
yeah.
And so I think there's a lot of work and research and information behind the details that will all start to come forward, and it will be very interesting to see. And I look forward to partnering with you and you sharing more of our insights on this as we get closer and closer to those IPOs. Maybe we can do one last topic here. Private credit. It's been in and out of the news. It's been a little bit quiet, more quiet, if you will, of late. And when we say of late, the last few weeks. And then out of nowhere this morning, and maybe not out of nowhere to me because I'm not following this particular investment particularly closely because we're not in it. But KKR had a write down of one of their investments, and so that sent the main private credit companies and their core stocks down or their values down today. Just curious from your take, is it safe to say that we're gonna just continue to see blips on the radar, if you will, but we maintain that private credit's in a fairly stable asset class on the whole, know what you own kind of thing, or do you see something bigger here that we should be aware of?
No, it's what you said. It's know what you own. I think there's definitely going to be some headlines here and there, but I think we continue to remain convicted in it. So let's level set kind of some of those numbers and the example you gave. So on average, private credit funds have a 1% default rate. That's on average, quite candidly, we never have 1%. You're either above or you're below it. Currently, as an industry, private credit is at about 0.6% default rate, so below its long-term average. So the point there kind of being, I think defaults only have one way to go, and that's up, but that doesn't mean they're going to 10%. It just means maybe they're at 1% or 2%. The fund you mentioned, which is the KKR FS private credit strategy, and it's a publicly traded business development company. It's got a 4% default rate. So it's well above kind of peers and everywhere it's at. Our actually private credit strategies that we've invested in are actually below where the average is today. I think the point there really being is it's just going to be knowing what you own, and it's going to be wide dispersions of outcomes and returns based on the underlying manager, their credit discipline, and what they own in their portfolios. And so I think they'll continue to be, the news wants to kind of highlight every default that happens. And I think at the end of the day, within private credit, there's just naturally going to be defaults. You have to expect that. That's why you're getting compensated with an added return for taking some of that risk. The other piece being the liquidity side of things. So we're in kind of more of a redemption cycle if some investors are choosing to redeem their interests. There are some evergreen vehicles where you can get in on a monthly basis, you can get out on a quarterly basis, but they limit that quarterly liquidity to no more than 5% of the fund's net assets. And there were some that had over 10% redemptions. So those investors that put in maybe only got half their money back, but that was kind of always been known. I think we've always figured that at some point in time with any evergreen fund, whether it's private credit or private equity or private real estate, that's likely to happen as maybe investors look to exit at similar times. And frankly, I think within private credit, we'll have redemptions that are above that 5% level for the next several quarters. That's not unexpected, but we're not seeing defaults tick up in aggregate. We're not seeing more non-accruals, meaning loans that have stopped paying. The credit profile seems pretty reasonable. I think the headlines will probably remain for a little bit of time, but if you know what you own, we think you'll be fine.
Yeah, I think knowing what you own, and the second part of that is know why you own what you own. One of the things I always would say to clients
Yeah.
when I meet with a prospect or a client that's thinking about making a change, one of the first questions I always ask, why do you own what you own? And oftentimes there's this blank stare over their face, and I'm like, the why is the purpose to the money. Like, this is why we live. This is why we partner with you as advisors. And this is what should be exciting, and what galvanizes advisors and clients together is really bringing purpose to that money. So two little things to think about: know what you own and know why you own what you own.
I like it.
Let's end this conversation in a way that's different than maybe we've done in the past. So let's go back to the top. where we talked a little bit about the economy, and we were talking about this inflationary world that we live in. When we translate that to investors, especially investors who are contemplating retirement, i.e., approaching retirement, are in retirement, and they're thinking about cash flow, right? How am I funding my retirement? For some people, it's as simple as like, hey, I've had a salary for whatever 35 years. I'm used to getting this paycheck every 2 weeks. That translates to, what is my retirement paycheck going to look like? What's that cash flow going to look like? One of the things that's, this is not new to our industry. There's all kinds of dividend strategies out there that in many cases really help not only fuel cash flow and or retirement needs, or funding in retirement, but still expose you to the equity markets, the chance for or opportunity for continued growth of those assets at the same time, albeit maybe slower growth than a growth oriented portfolio itself. But we're pretty excited about a dividend strategy that we're launching as part of our overall investment portfolio. And it's not for everybody, but we're excited about the work that's gone on behind the scenes for the last couple of years, and it's coming to market now. And so maybe you want to make a couple of comments about how we're thinking about our dividend growth strategy, and what that looks like as a way to wrap up today's call.
Yeah, there's a lot of just academic research out there that kind of shows if you just chase high dividend stocks, you end up not with the best outcome, because oftentimes the highest dividend stocks have something going wrong and their price is low, which is why the dividend yield's high. And we tend to stay away from those. And Rusty Haas on our team's been really leading this effort to look at, can we find companies that pay above average dividend yields? They don't have to be high dividend yields that are 6 or 7%, but the S&P is giving you, call it a little under 1.5, and we can get you 3 and double that, but also be in companies that are growing their dividend at rates well above inflation. So if they're growing their dividend 6, 7, 8, 9% a year, you can take that 3% dividend and grow it as at the basis of your capital over time, where you're actually outpacing inflation. And we think that's a good way to get equity upside, to get income into your portfolio, and also protect you against and be a hedge against inflation. You have to take equity risk. So it's not, as you said, Nate, it's not for everyone. But it's an interesting way to kind of get more cash flow into your portfolio and do so in an inflation adjusted way.
Well, Matt, it's a great place for us to end. So thank you for your insights. If you have questions on anything we talked about today, whether it's the economy, it's Iran, it's AI, it's private credit, it's tariffs, whatever it might be, please reach out to your advisor. We'd love to engage Matt and his entire team to help answer those questions. If you have questions about our dividend growth strategy, love to talk to you about that as well. In closing, thank you for your trust. It's an honor and a privilege to serve you as our clients. We look forward to talking to you again before long. Thanks, Matt. Appreciate your
Thank you.
insights today.